Welcome back to the Deep Dive. Today, we're taking a close look, really diving into the Q2 and H1 FY26 financials for GoDigit General Insurance.
Yeah, and the headlines look pretty dramatic.
Absolutely. Profit before tax, PBT, jumped, 53% quarter over quarter, reaching 136 crore.
And profit after tax, PAT, also strong growth, 31% QOQ to 117 crore.
So on the surface, explosive numbers?
They are undeniably strong metrics, but there's definitely a story behind them. And that's our mission today, right? To look past those headlines.
Right. We need to dig into the filings, the earnings call, understand what's really driving this.
Especially, I think, two key things. First, these new accounting rules, how they're impacting the reported results.
Okay.
And second, this high-growth product mix they have. Is it actually creating a kind of paradox in their current profitability?
Yeah, that classic insurance balancing act, isn't it? Growth versus margin.
Exactly.
Okay, before we get tangled in accounting weeds, let's just, nail down some basics. The foundations look solid.
Oh, yeah. Assets under management, AUM, up 15.4% year over year, sitting at 21,345 crore. It's a big number.
Huge. And the capital buffer.
Yeah.
The solvency ratio.
Rock solid. It stands at 2.26x.
Now, for listeners maybe not tracking insurance ratios daily, just quickly, why is 2.26x significant? What does that tell us?
Well, the solvency ratio basically measures the capital they have versus the minimum the regulator requires.
Which is 1.50x in India.
Right. So being at 2.26x means they have more than double the required capital. It shows they can handle unexpected big claim events.
A strong balance sheet, basically. Lots of cushion.
Exactly. And capacity for future growth but without needing, immediate extra capital.
Excellent. Okay, strong base. Now, let's tackle that complexity you mentioned. The reported numbers, specifically gross written premium, GWP,
Yeah.
GoDigit flagged this big change in how they book long-term premium, this one-in basis. What is that exactly, and how does it cloud the picture?
Right. So this kicked in October 1st, 2024. It changes how premium revenue is recognized over time. Before, for long-term policies, think like a 5-year third-party motor policy, they often book the entire premium as revenue right away, upfront.
Got it. All in year one.
Yeah. But under this new mandatory one-N rule, they have to spread it out, recognize it evenly over the policy life. So if N is 5 years, only 1/5 gets recognized in the first year.
Ah, okay. So instead of getting that big GWP hit immediately, it's smoothed out, which means their reported growth might look slower than the actual business being written.
Precisely. That's the key point. Look at the numbers they gave. The reported Q2 GWP was 2,667 crore. That's 12.6% growth year over year.
Okay, 12.6%.
But, and this is crucial, they said if you adjust for that one effect, look at it on a like-for-like basis, with last year, the GWP would have been 2,739 crore.
So that's 15.6% growth, not 12.6%.
Exactly. That jump, that 3 percentage point difference, shows the underlying business growth is actually much stronger.
And significantly outpacing the rest of the industry too, right? Which grew around 10%.
Yeah, on a comparable basis, the industry was about 10%. So 15.6% is really strong, shows good momentum.
Okay, so the one rule kind of masks the true top-line growth. Does it also affect how we should view their underwriting efficiency? The combined ratio, COR.
It absolutely does. And maybe let's quickly define COR, just to be sure.
Good idea. What is it?
So the combined ratio, it's the key profitability metric for insurers. It's basically claims paid out plus all the expenses divided by the premium earned.
Simple enough.
If it's 100%, you broke even on the insurance itself. Below 100, say 95%, you made a 5% underwriting profit. Over 100, you lost money on the core business.
Got it. So GoDigit's reported COR for Q2 was 111.4%, over 100. That sounds not great.
On the surface, yeah. But again, you have to factor in that one-N rule depressing the earned premium denominator.
Okay.
When you adjust for that, calculate the COR on that same like-for-like basis, it actually improves quite a bit. It comes down to 109.9%.
Okay, 109.9%. That is better than the 112.2% they had in Q2 last year.
Right. It's a 2.3 percentage point improvement in underlying efficiency. Shows they are managing claims and costs better, fundamentally.
But hang on, 109.9%?
Right.
It's still over 100? Even on the adjusted basis, they're technically losing money on underwriting, right?
Yeah.
Needing investment income to make a profit. Should we be worried?
That's a fair question. It does show they're prioritizing growth and market share right now, maybe accepting slightly higher costs to achieve that scale.
Trade-off.
A trade-off. But, and this is where it gets interesting, this underwriting loss, particularly the part driven by specific products, is arguably quite temporary. It feeds into this idea of future locked-in profit.
Okay, that sounds like a perfect segue. Let's move into that. Section 2, the operational mix.
Yeah.
Motor is huge for them. They hit their highest ever market share, 6.2% in Q2.
Yep, big milestone.
But the mix within motor, especially two-wheelers, that's causing this IGAP paradox you mentioned.
It really is. Let's break down the motor book. Private cars, about 45%, commercial vehicles, 25%, and then two-wheelers make up 30%.
Pretty significant chunk.
And it's the fastest growing part, often involving these long-term, like 5-year policies.
And this is where Indian GAAP, IGAP gets tricky, right? Compared to the maybe international standards.
Exactly. IGAP tends to be more conservative, especially on costs. So when Go Digit writes that 5-year two-wheeler policy, IGAP says you have to account for the entire 5 years worth of commission cost right now. Up front.
Pay the agent now.
Pay the agent now. But because of the 1N rule we just discussed, the revenue associated with that policy only trickles in over the 5 years.
Whoa. So you're hitting the P&L with 5 years of cost, but only 1 year or even less of revenue in that first period.
Precisely. High growth in this specific profitable product looks bad for current reported profit under IGAP.
That seems incredibly counterintuitive. Can they quantify that? The hit they're taking now for future gain.
They did. And this was, I think, a key insight from their call. They said the extra new two-wheeler business they wrote this quarter, about 117 crore more than last year's Q2.
Okay.
That extra business resulted in an estimated 53 crore negative impact on the current quarter's profit. And it directly worsened the combined ratio by 2 full percentage points.
Wow. 53 crore less profit reported because they successfully sold more long-term profitable policies. That really highlights the accounting distortion.
It's the price of that specific type of growth under these rules. Now, stepping back from the accounting for a second, let's look at actual claims in motor.
Right, the underlying performance.
The motor-owned damage, or OD, loss ratio was 71.3% in Q2. They did note this was pushed up by about 30 crore in losses, specifically because of floods during the quarter.
Catastrophe losses, always a factor.
Always. And related to that, they made an interesting point about electric vehicles, EVs.
Oh, yeah. Oh, that.
When talking about the flood claims, management sort of flagged a potential risk. They believe many insurers might be underpricing new electric cars.
Why?
Because in flood scenarios, their data showed the loss ratio for EVs could be 20% to 25% higher than for similar petrol or diesel cars.
20 to 25% higher. That's huge. Is it battery damage? Electronics?
Likely a combination of both. Water damage to high-value batteries and complex electronics seem as much costlier to repair or replace.
That's fascinating. It suggests that as EVs become more common, the risk profile for things like flood or even fire could change significantly. Insurers need to adjust pricing.
They absolutely do. So Go Digit is juggling this, right? Growing fast in two-wheelers despite the IGAP hit, managing these cat losses, and trying to price emerging risks like EVs correctly. It's complex.
Definitely complex. Okay, so that leads perfectly into Section 3. If growing the two-wheeler book hurts the current IGAP profit by front-loading costs, where does that value actually go? Where's the profit stored?
It's stored on the balance sheet, essentially, in an accounting item called deferred acquisition cost, or
Yes, okay.
this is really the bridge between the conservative IGAP view and the international standard IFRS. Under IFRS, you're allowed to match the cost of getting the commission with the premium as it's earned over the 5 years.
So that upfront payment isn't an immediate expense under IFRS.
No, under IFRS, it's treated as an asset, the deferred acquisition cost. It represents the cost you've paid for future revenue you expect to earn.
Okay, so DATAs isn't just some accounting line item. It's like a pot of prepaid future earnings, backed by business they've already written and paid commissions on.
That's a great way to put it, and this is the number you really need to watch. As of September 30th, 2025, Go Digit had accumulated a total data, this is post-tax, on an IFRS basis of 1,708 crore.
1,700 crore. That's a massive amount. It really shows how much profitable business is sitting there, waiting to flow through the IGAP P&L.
Exactly. And here's the kicker, the forward-looking bit. The company explicitly guided that they expect 710 crore of this DAC to unwind, meaning it will flow through and boost IGAP profits just in the second half of this fiscal year, H2 FY26.
710 crore in the next 6 months.
That's the expectation. So the pressure we see in Q2, it really looks like a timing issue driven by growth and accounting rules, not a fundamental profitability problem. The profits are just deferred.
That completely reframes the narrative, doesn't it? From underwriting loss to massive locked-in future profit.
Ah.
Okay, besides motor, what other growth areas are contributing to this future lock-in?
Well, their commercial lines are performing really well. The fire segment, GWP, grew by a huge 60.8% in Q2.
60%. How does that compare to the industry?
It blows it away. The industry grew fire GWP at about 27.6%, so more than double the market growth rate there.
Impressive. What about other lines? Health, travel?
Also strong, the combined health, travel, and personal accident segment grew 36.6% in Q2, healthy growth across the board.
And on health, I remember seeing a detail about the loss ratio. It was 84.3% overall, but there was a nuance.
Right. They pointed out that about 70% of their health book is group business employer-sponsored plans. And that 84.3% overall loss ratio includes some newly written government health business. Apparently, that specific block runs at a naturally higher loss ratio, maybe 90–95%.
Like some social schemes or specific mandates?
Could be. But they said if you strip out that particular government business, their core commercial health loss ratio drops to a much more standard 80.8%. So they're managing the core book well.
Good clarification. Okay, shifting gears slightly. Alongside the results, the board approved 2 interesting director appointments. Given everything we've discussed about accounting shifts and regulations, these seem quite strategic.
I think so. They definitely signal a focus on navigating this complex environment. The first is Mr. Giridhar Oramain. He's appointed as a non-executive independent director.
Okay, his background.
He's a former senior IAS officer, very distinguished career, including being defense secretary.
Impressive public service. But for Go Digit, what's the key experience?
The clincher is his regulatory background. He previously served as an executive director at IRDAI, the insurance regulator itself, from 2009 to 2012. So direct experience inside the regulator.
Exactly. At a time when the company is dealing with major regulatory-driven accounting changes like 1N, having someone with that deep inside understanding of IRDAI and government thinking is incredibly valuable. Strategic insight.
Makes perfect sense. And the second appointment, Mr. Michael Wallace.
Yes, Mr. Wallace joins as a non-executive director. His background is pure insurance operations and underwriting over 30 years in property and casualty.
Okay.
He's currently a vice president for insurance operations at Fairfax Financial Holdings, FFHL.
Fairfax, their major shareholder.
Right. So this appointment brings deep global insurance operational expertise. Think efficiency, claims cost control, underwriting discipline, especially relevant maybe with those emerging risks like EVs we talked about.
So one appointment brings regulatory insight, the other brings global operational best practice. Seems like a good combination for this stage of their growth.
Agreed. Reinforcing governance and expertise. Okay, let's try to wrap this up. Summarizing our deep dive today. The headline profit jump for Go Digit was real, driven by strong growth.
But the true strength is sort of hidden beneath the surface right now because of that 1N accounting change.
Right. The underlying GWP growth was actually a very strong 15.6%, much better than reported. And their core underwriting efficiency, the like-for-like COR, improved by 2.3 points year over year.
Even though the reported COR looks high. And we identified that a chunk of that current pressure comes from the two-wheeler business.
Yeah, where writing more long-term profitable business paradoxically hurts the immediate ICAP profit because costs are booked up front against revenue that comes later.
Exactly. Which leads us nicely to that deferred acquisition cost, the DAC.
The hidden value store.
Precisely. And that brings us to our final provocative thought for you, the listener.
Okay.
Go Digit's real story, you could argue, isn't in the quarterly P&L right now, but in that DS balance. They've built up over 1,700 crore of it.
And they expect 110 crore of that to flow into profit in just the next 6 months.
So the question to ponder is, what does that massive DAC balance and its expected rapid unwind tell you about the real underlying sustainable profitability of the business they're writing today?
It suggests the current cost of growth is really just an investment, locking in huge future earnings that are almost guaranteed to show up soon.
Exactly. It challenges how we read traditional accounting statements in high-growth, long-term businesses like this. The true picture might be much smoother and much more profitable than the quarterly numbers suggest. Look beyond the quarter.
Look at the locked-in value. Great point to end on. Thanks for walking us through all that complexity today.
My pleasure. It's a fascinating case study in accounting versus economics.